You're listening to the Millennial's Choice Show, Canada's most trusted podcast on all things real estate, finance, and entrepreneurship. Here's your host, Matthew Ablakan.
What's going on, everybody? Welcome to another episode of the Millennial's Choice Show. I'm your host, Matthew Ablakan, and I'm here with my brother, Danny Ablakan.
What's going on, my man?
You know, Danny, same old buddy. Creating content. In a couple of years, I want to look back and say, I worked extremely hard.
Anyways, crazy stuff happening with Silicon Bank. Let's talk about this craziness now.
First of all, I don't appreciate what you just did. But yes, today we have an awesome episode. We want to talk about the collapse of Silicon Valley Bank and what that means for us in Canada, what that means for, Americans. We're not going to get into, heavy detail. We're not bankers, but there are some things that you should be aware of, especially you're here in Ontario. You're in Canada. You have to understand that the banks are just a business. And that's what we want to talk about today and what that means from that perspective. Before we do, thank you guys. We recently reached 5K subs. Woo. That's big for us. And we want to take it to 100K to 1 million. Like we're not stopping.
We're not stopping.
So thank you for all your support. Like, subscribe, leave us a comment, share this with your family and friends. If you're listening to this, download the episode, leave us a review. And let's get right into it. So, yeah, I mean,
should we all withdraw our money from the banks? Like, what's going on right now? Let's talk about it.
So personally, I don't have any money in the banks. That's the truth.
That's the truth. That's the key.
Truth. Actually, I don't mind going to my online banking and showing people, but it's a lot of negatives, like overdraft and lines of credits. And that's not because I can't pay them off. That's just because I buy real estate. Some real estate, I buy it with cash. I don't get a mortgage on it. So, it's just whatever makes sense for me, whatever's easier, whatever's going on in my life and all that. If I'm busy or if it just makes sense for me to buy that and do that. So I have a lot of stuff that's negative, but I'm going to be paying it off. I always pay it off, use it, pay it off, use it, but I never keep a lump sum in my account.
So wait, you use your money for yourself. You don't just give it to the bank and let them hold on to it?
No.
And geez, that's a great idea. Revolutionary.
So, yeah, I mean, the banks are just a business, and they've done a great job, Danny, right, at marketing. Marketing is the bank's like one of the biggest things they've done well because, in every corner of every major intersection, you'll see almost every single of all the five banks.
Every color, man.
Yeah, maybe the four of them, the more well-known brands. You'll see them typically in every corner of a major intersection.
For sure.
So it's just a business, you guys. That's what I'm trying to say here. It's just a business. And with any business, businesses can fail. Now, granted, the banking system in Canada is a lot more strict and regulated than it is in the United States.
100%. Hands down.
Just like in 2008 when there was the big financial crisis, the US dollar became par with Canadian dollar. And although our market faced some, we felt some of the blowback of what happened in the States, we didn't crash.
No.
They did. We didn't. So I know a lot of people, they're always talking about in Canada, they're posting stuff on Instagram. They're talking about what's happening in the US as if it directly impacts us. It doesn't always do that. This is important because this sends psychological, shockwaves everywhere. Like that's why we're talking about it. But also it's important to understand some of the basics of what's happened, and understanding that can lead to maybe you taking a different, path and making a different choice. So for example, in Silicon Valley Bank, they found that just over 97% of all of the deposits, so almost 100% of all the deposits were $250,000 or more.
Yeah.
Which means that if your deposits were over 250,000, the first 250,000 is insured. You're going to get it back even though the bank collapsed. It's insured. But anything over that is not insured.
Just to clarify, so I think they're saying it's up to $250,000 per depositor, like each person. That's what's going on. That's each person has.
Yeah, whoever has
exactly. So they're
most deposits, most people's deposits.
Yeah.
were over $250,000.
Exactly.
So whoever's deposits were over $250,000, they lost those.
So if like somebody, for example, has given the bank $1 million in deposits, right?
$10 million.
Whatever. $1 million, 10 million.
Yeah.
The most they're getting back from the insurance is 250 grand, which means anything above that, you lost it.
You lost it because the bank is gone under.
So let's just talk about that real quick, because a lot of people don't know this, but when you give your money to the bank and you deposit it, right? The bank actually goes and invests that money, right? Typically into very secure things. A lot of time, like in this bank specifically, they invested that money into securities, which is in the form of the U.S. federal bonds. They bought long-term U.S. federal bonds, 5-year and 10-year bonds. So I'm not sure if you went this deep into it, but I was reading a lot about it. Long story short, guys, they invested in these bonds because they're long-term, that you have to keep them long-term. And the rates on those bonds, the rate of return on investment was actually going down as the rates in the States were increasing. Yeah. So what happened was it created a liquidity issue where people were trying to go to the bank and withdraw their money, and the bank didn't have enough reserves. So what they ended up doing was they ended up selling a lot of the reserves they had in the actual bonds, and they sold them at a loss, right? That's how you lose a lot of money. So I can't remember the number exactly. I don't know if you know it, but
it's in the billions.
It was I think
168 billion or something.
Yeah, they lost billions.
So just to go back to that point. So 250,000 of anybody's deposits are insured. If you have 10 grand in the bank, that's all you're going to get. You're not going to get 250, but that's what's protected and insured. So what the U.S. government did, what the Federal Reserve, their central bank did, is they had an emergency meeting, and they said, you know what? There's a fund. There's a special fund that banks already lend into, or not lend into, I should say. They contribute to, and that fund is for moments like this. So what we're going to do is we're going to give back all the other people's deposits, like all the 97% of the deposits that were over 250,000. Everyone's going to get it back at no cost to the taxpayers because we already have this fund. That's what they said. Okay. So whether you believe that or it's a bunch of baloney or how is that going to affect taxpayers or not, that's a different story. That's a different conversation. But the point is that this happened. And if the government is not stepping in, and if the Federal Reserve, the central bank, is not stepping in and saying that we're going to give those deposits to people, they're not going to lose those deposits, then in reality, a true capitalistic society will let that bank fail, and whoever loses in the process loses. Yeah. And that is extremely detrimental to the economy, right? Now we're starting to see that stuff happen in Europe. We're starting to see another bank that I think the New York, I forget what it's called, the New York Bank or something, also got shut down on Monday. Yeah. Just a couple of days following the shutdown of Silicon Valley Bank. Banks in Europe are facing major liquidity issues as well. So this is happening around the world. It can happen anywhere you are. Whether this is going to be the storm that creates I should say, whether this is the trigger point that creates the perfect storm for central bank digital currencies. Again, that's another conversation. Yeah. But the point is, we want to focus on real estate and finance, and specifically Canadian banks. So you know how these American banks, 250,000 of it is insured. In Canada, it's 100,000. Yeah. So it's not even 250. Much less. Yeah. Anything over, if you have a bank account with anything over 100K, if something happens and the banking system fails, then you're protected for up to $100,000, nothing more. Now, the cool thing is, and I don't know the details on this, this is where you want to speak to the CDIC or CDCI, I forget what it's called, protection representative, someone from there. Just go on their website, type it in, and you know what? I don't want to say I don't know. It's CD. Do you know which one?
Are you talking about the States one or ours?
No, ours. It's CDIC, or I want to pull it up because I want people to CDIC, Canada Deposit Insurance Corporation. Yeah. Go on their website, and if you're living in Canada, go on their website and they'll tell you which accounts are protected, which accounts are not, because there's certain investment vehicles like stocks, bonds, mutual funds, that's not protected at all.
I don't think TFSA's
TFSA is protected.
Oh, they are? Okay.
Yeah, RESP is protected. I think our DSP, our disability savings plan, is also protected. There's a few of them that are protected. So you as one person, if you have $1 million, you could potentially open up 10 different accounts, spread that money out. So it's 100 grand per account. And now your full $1 million is actually protected.
So they don't go based off of just the one person. They go off the different accounts.
It's the account type.
Okay. It's good to know.
Yeah, I was looking into this. So that's a strategy right there. That's a hack right there, where if you want to make sure something like this never happens, you got 10 million in the bank, $1 million in the bank, 200,000 in the bank, split it up so that the most in one account that is protected under the CDIC protection plan, that each of those accounts have 100K. So it's spread out so that you, in the event that it does happen, you get all your money back. Yeah.
So what I was going to say was just a quick point to highlight about the Silicon Valley Bank. It's not your typical bank when it comes to its clientele and customers. It's not a mom and pop and families and things like that. Majority is tech startups, hedge funds, venture capitalists. So what happens there doesn't necessarily mean it's going to happen with us and like our banks, right? Just because of the nature of their clientele. It's a very different group of people.
It's not necessarily. It's not a JP Morgan.
No, it's not a Goldman Sachs.
It's not a Chase. It's not a Goldman Sachs. But the thing is, and I don't think that it could happen here, but I don't think it will.
It's not likely.
It's not likely. But here's the thing, though. It could happen.
It could happen.
And so when you're coming to me and you're talking to me, a lot of people reach out to me on Instagram and will message me and say, well, is now a good time to buy? Like the most basic routine questions we get all the time. Is now a good time to buy? What do you think is going to happen to interest rates? They're all the wrong questions to ask, but those are the questions people ask. And they're the wrong questions to ask because most people who reach out to me want to invest in real estate, and they're not asking the right questions about how to treat a real estate investment and how a real estate investment gets treated by CRA, by so many different groups. So you're asking the wrong questions, but the point is that can happen here. And so if it could happen here, why not take preventive measures to protect yourself?
Yeah,
and if you're putting your money in the bank and saying, I'm going to wait, another thing we hear all the time, I'm going to wait until the market crashes. I'm going to wait until the rates come down. That's what we're hearing a lot of recently. If you're going to wait for that, then at the end of the day, you're making a foolish decision and a very unwise decision by leaving your down payment or your deposit of 200 grand or whatever in the bank.
That's still a decision. That's what people don't
That's
really
still a financial decision.
It is. You're leaving it there, right? So there is still risk, right? People think, oh, it's in a bank account, a savings account, nothing could happen. Well, it could happen. Look what just happened in the Silicon Valley Bank, right?
It could happen. And not only could it happen, as you're leaving it in the bank, you're making an investment decision. It's not about you just made a decision to leave it in the bank.
No.
You're making an investment decision because of inflation. So your money is becoming worth less and less as things become more expensive. Everybody who's been waiting to buy a house, you tell me when the best time was to buy a house over the last 10 years for everybody who's been waiting.
10 years ago, literally.
10 years ago. That was the best time because when were you going to buy a house? In 2018 when things came down a little bit, but we're still high, and everybody said, oh no, the stress test is gonna, because 2018 the stress test came into effect.
Yeah.
Oh no, this is gonna crash. Never did. Went back up, and then like it came down a bit, and then skyrocketed up, and that's where we've been this whole time.
It's still higher than that time.
And now, for the first time in a long time, we've seen rates the way we're seeing rates where they are, and that's causing huge unaffordability issues, and combined with a supply shortage, combined with lots of immigration, combined with, a growing country, a province. We live in Ontario and in Toronto. Lots of people want to come here.
Open borders, man. That makes a huge difference. What people don't understand.
Makes a huge difference, yeah. So if I'm buying real estate as a rental, why do I care what happens to its value? Of course, I want to do a refinance. Of course, I want to take some equity out. And that's pretty easy to do. But why do I care what's going to happen to the value? My purpose is to hold it for the long term, rent it out, and then somebody else is paying my mortgage, all my expenses.
Even if you're living there, dude, the value doesn't matter. You're living there.
Oh yeah, like we check. You know me, I'm always checking what our house is worth.
You just check for fun,
just
though.
For fun, though. Yeah.
But like you're living there. Like unless you're planning on, again, and this is not what we recommend people do. If you're buying to hopefully flip in a couple months to make a profit, you're not going to make money. You're going to lose money for the closing costs and things like that. So if you're buying to live there, you're living in there. Why do you care what your house costs? All you have to worry about is making the monthly payment. That's it.
Well, Danny, it comes down to what, you know, people ask, why are you interviewing Sean Atwood? Why are you interviewing, you know, Kirk Calabrese? Why are you interviewing Anthony Arlott? All these guys wanted to make fast money.
Yeah, literally.
Fast money. And Sean Atwood would make $500K selling stocks as a stockbroker, but then wanted to make faster money and got into selling ecstasy. Everybody always asks, why? Because we can learn from them. Everything they're telling us from 20 years ago, actually, no, those guys in the 80s and 90s, a little more, 40 years ago, 50 years, they're telling us what to avoid. Some of them buy real estate now and buy it for the long term.
And some of them that didn't buy real estate regret it. They're like, we wish we just bought real estate. We would have been good. We would have had tens of millions of dollars. You've heard them say that.
Like most of our audience listening to this is in the age group 25 to 34. So I'm part of that age group. You're part of that age group. Carson, I think you're part of that age group, right? 25 to 34? Barely. Barely. But the point is that age group, including I could speak for myself, sometimes we're not thinking about what it's going to be like when we're 50. Yeah. I'm to blame for myself for that. The stuff I do sometimes, it's like, aren't you thinking about when you're 50 years old? It's true. How that's going to, you know, not be anything bad, but like, you know, for example, like work out every day so that by the time you're 50, your body is better, right?
The stuff we put into our bodies.
Yeah,
like
what
all
are we eating? That's what I'm referring to. So what I'm saying is like a lot of us don't think of that. So yes, we'd like to have the nice car now. We'd like to have the nice house now. We'd like to have all these things now. But it's like, you have to have a long-term mindset. So with my portfolio, my real estate portfolio, I do have a long-term mindset. You know my portfolio. Yeah. I've never flipped anything with the exception of my second townhome. My second property I ever bought was a townhome, flipped it to buy our primary residence. Now I've done a couple of flips where it's like in a building, if I buy 3 units, I'll flip one of them just before closing. I don't even list it or anything. I just flip it. Yeah. And so I've done that a couple of times. But that's it. I'm a long-term hold kind of guy and I rent it out. And sometimes I refinance and sometimes I don't if it doesn't make any sense to do so. And so when you guys are buying real estate, that's the mindset you should have.
I was just going to say it's the mindset. And I know we always bring it up because it always comes back to that though. It always comes back to that, right? It's all about the mindset. And like you said, all these people we're interviewing, look at the mindset they had at that time. And they pretty much all say, well, we wish we did this differently about, you know, our money or whatever the case was, right?
Always.
So
always they wish, and most of it, they don't even wish that. Some of them, they don't wish that they were part of that life. They just wish that they stuck to one thing and it was making them money and the violence wasn't there. Like that's what it's all about. These guys all want to make money. Like we all want to make money.
Oh, for sure.
We all want to do that. We want to thrive and whatever, but you have to have the right mindset around real estate and, you know, surround yourself with the right people. Like I have people asking me questions about becoming private lenders now. Everybody wants to be a private lender because the rates went up. What they don't see is that private lenders are actually limiting their risk. They're not lending as much money anymore. They're holding back. And yeah, they have a higher rate of return because it's riskier.
How much riskier it is. Like, of course they're going to charge, 10% for a first mortgage if you're lucky. But yeah,
14
like
you're 13, 14%. Yeah, the returns look great.
Look at the risk.
But those same people, they talk to me about it. I'm like, okay, I'm going to give you some information. But then, speak to your accountant how that 14% becomes 7. Yeah. Because it's passive income. So now your return is 7. Because some of these guys, what they do is they borrow on their line of credit at 7, thinking they're doubling up because they're lending it out for 14, not realizing it's 50% tax. It's portfolio income. Yeah, man. Why would you want that? Buy the real estate. The real estate allows you to now have leverage, to have tax benefits, to have renters paying down your mortgage, paying down your expenses. And for a lot of people who are saying like, oh, well, I want to buy something that cash flows today. Okay, it doesn't. And it
doesn't exist.
And if it does, it's very rare.
It's very rare in our market.
Yeah. But then I say, okay, guys, rates are the problem. 6% versus 2, 6% versus 4, 6% versus 3. Some people are getting 8%, with B lenders. So that's the problem. So we always say this, you're going to date the rate, you're going to marry the property. Yep. So stick it out for a little bit if you want to buy an existing property. If not, jump into pre-construction where it's going to be ready in 2-3 years. Some projects now are going to be ready in 5 years.
Yeah.
You know, you don't have to worry about the mortgage today. So there's a lot of avenues, but I just think a lot of people are not serious about it.
100%. Whenever I think about real estate now with this new mindset, it's a utility asset. You can leverage it for tax-free money. Yeah. I never understood this honestly before I started investing, but getting access to tax-free money is huge. That is massive in of itself, right? And the fact that you're able to put somebody in the house and they're going to pay down your mortgage for you, and while the property value is going up, that's a no-brainer. Now, obviously looking back, now that, you know, I've invested and whatnot. So it's just crazy how people don't really want to take advantage of it. And there is that fear. And I think it does go back to that mindset where they're scared, you know, they just want to kind of make something guarantee happen, which obviously doesn't exist, right? Because if it was guaranteed, everyone would literally be wealthy and rich, right? So it's not what happens. So
when that tax-free money hits your bank account, those are like, that's what I'm saying. Like, you look at my bank account, lots of negative, because I closed on a big deal. And now once I do a refinance or once I get paid on some commissions or whatever, I just pay it off. Yep. But the money is still there. Like, some people would rather have a $50,000 line of credit and then have $100K in the bank. It's like, I'd rather have the $50K line of credit. I could use it at any time, and I've invested the $100K. But I have the $50K to like lean back on.
Yeah.
I don't keep my money in the bank. I simply don't. That's just never how I've been. And what Danny means about tax-free money is when you do a refinance. So a refinance is you increase your mortgage, you increase your line of credit amount, the line of credit that's attached to your mortgage, to your property, you increase it. And then what you do is you go to the bank, you increase it, and then you get that money. If it's a line of credit, it works like a credit card. You have access to it when you need it. If they increase your mortgage and just give you the money, then you get a lot of money just directly into your bank account, and you can use it for whatever you want.
Yeah.
So,
and you don't have to pay taxes on it.
And you don't pay
it's
tax
not income.
on it. So it just increases your mortgage. So for example, let's use easy numbers. You buy a property and now it's worth $500,000, but you have a mortgage on it for $200,000. You bought it for $3, you have a mortgage on it for $2, and now it's worth $500K. You could go to the bank and they'll give you up to, in this case, let's say $400,000.
Yeah.
80% of it. They'll give you $400,000, but you have a mortgage of $200,000. So the difference is another $200,000.
Yep.
That $200,000, either you'll have it as a line of credit that you could tap into at any time, or the option you could get it as cash. And basically your new mortgage amount goes from $200,000 to $400,000. Yes, you're incurring more debt, but again, it's a rental property. Someone else is going to pay for it.
Yep.
So, and all the interest on that extra mortgage amount or on the line of credit when you use it is a tax write-off.
Yep.
Is a tax write-off. Is a tax write-off. I have to
literally
get that
keep saying
through your head. Like, it's a tax write-off, guys. It's free money that someone else is paying for. So you have this extra $200K. What do you want to do with it? You're going to go buy a Lamborghini. You're going to go buy a fancy watch. You're going to go do something. Listen, you honestly can. You could do that.
Yeah.
If that's all you wanted to do, one property and get that money and that's it, be a shooter, that's it. But what some people do is they take the 200, they spread it out. Now they put another deposit on a property. Now they buy a second property with it. And, you know, second question we get, well, how am I going to get financing? I got financing on this one property. How am I going to get financing on the second one? Well, when you can't go to all the A lenders, the big banks, but you need financing, you do what I did when I first started, and I was doing this exact formula. I went to B lenders. Oh, but the rate is higher. It's a tax write-off. It's a tax write-off. It's a tax write-off.
That, and even like in this market right now, you know, if you're going with a variable rate, it's at 6.5. Some other lenders even a little bit higher. The B lenders are around 6.5.
I just closed my deal with a B lender at 6.09 fixed.
There you go. Even lower. So yeah.
But the point is, it's a tax write-off. I'm not talking to you guys about buying your primary residence this way. That's a different conversation. I'm talking about investments. Yeah. Once you get a few investments under your belt, then look at, let me get into the primary residence. That's how I look at things. Not everybody does that. Not everybody does that. But I think it's a good start, especially when right now you can't buy the primary residence that you want. that you forever see yourself living in.
No.
So then what's the point of buying something you're going to temporarily live in, and it's going to cost you money every month? It's going to be a liability. Instead, live at home, guys. Sarah and I lived at home for a year when we were getting married and all that. We were renting where we were living before that. You know, stay at home. Stay at home. Your parents are there. They want you to stay, hopefully, and you know, they'll pay for everything. And you could just save, but invest. You know, invest your money in a rental property
100%,
and use that now to grow. So that's how you could grow the empire in your early 20s. We've seen people in their late teens do it. I did it. My first property at 19 years old. All your 20s, you could do that. All your 30s, you could even do that. Whatever you want, you can do it. But you got to get in. You got to get into something.
It's never too late to start, right?
Yeah, you got to get into something, and then. Yeah, so that $200K, that's what I would do. So that original condo that I bought at 19, I'm 31 years old at the time of this recording. I bought it for $305. I had a mortgage on it for $240. I refinanced it a year later and got like $260. I got $8,000. So $270, call it $275-ish. That was my new mortgage, and I paid my tuition off. I never paid a penny in interest because I refinanced the condo. Took that extra $35K, paid off my tuition, what was left of it. So I never paid a penny in interest in like student loans and stuff.
It's awesome.
Yeah. And then now today, fast forward today, that property has a mortgage on it of just under $520,000. I've refinanced that property 4 times.
Yeah, that's insane.
Yeah. So I bought it for $305.
But
I have
why
a
not,
mortgage
though?
on it for $520. It's worth $650 today in this market.
Yeah, but why not? Like, why wouldn't you do that?
And
It's
never
just money
pay tax.
sitting there, right?
Never pay tax. If I sold it for $650, all the appreciation, taxable.
Yeah.
Now I don't have to pay tax. I write off the interest on the $520, the mortgage. My tenant is paying for almost everything. It's a little bit over leveraged compared to the rents. My tenants have been there for like 3 years, but that's okay. The principal portion of the mortgage, I'm paying it down. No big deal, because I got me an extra how many hundreds of thousands that I've invested, and everything else is a write-off. All the interest on it, everything is a write-off. So no brainer.
No brainer, man. That's crazy.
Yeah. So there are vehicles out there that you could tap into. There are other investments. There are, real estate investments you could get into that you don't need to get a mortgage on today. Or if you get a mortgage on today, again, long-term mindset, rent it out, bite the bullet on the interest for the beginning. But you can do that. You can do that today.
And a quick point, like we don't bash banks. We work with the banks. We help people get mortgages from big, huge banks. The banks are there to honestly help people get into real estate because
the banks are your partners.
You need to partner up with them, but you need to use the system to your advantage, right? That's what we're telling people right now. Don't just go and keep your money saved there like we were just talking about.
Absolutely. Yeah. Absolutely. And guys, this episode I think was super impactful and insightful. And any last thoughts on your end?
That was it. No.
Okay, guys, if you listen to this to the very end, we appreciate it. Again, thank you for getting us to this point, and we're always going to commit to bringing you the most up-to-date, most relevant content for you guys. Learn, absorb as much as you can. First you learn, then you earn. And until next time, we're out.